Welcome to Breaking News to Trading Moves. We take the latest market headlines, look at the material shared with us, and immediately zero in on what the short-term trading tape sees as the winners and the losers.
Today, we're analyzing the specific market reaction to Broadcom's fiscal Q1 forecast. And this news created a classic tension.
Attention how?
Well, traders were forced to reconcile a clear, strong signal of demand for AI products with a subtle but, very telling note of caution regarding profitability.
Okay, so we're going to walk through the specifics of that forecast, examine the main reasons the market reacted with some skepticism, and then we'll detail the key categories of companies the market sees benefiting and the categories facing pressure from this new margin narrative.
Sounds good.
All right, so let's establish the baseline. Broadcom, stock ticker AVGO, indicated they expect a much stronger than expected fiscal Q1 revenue.
Right, and the reason for that strength is pretty straightforward.
Yeah.
Just extremely high demand for their AI chips and, crucially, their AI networking products. We're talking about massive volume here.
The top-line numbers look fantastic then.
They do. But here's the rub and why the market paused. Broadcom also provided guidance for slightly lower gross margins.
And the explanation was that their AI-related system sales, the very products driving that stellar revenue, are just making up a larger mix of their total business.
Exactly. And those system sales are inherently lower margin.
So Broadcom shares actually slipped in extended trading after this announcement, which shows you exactly where the market's focus was. The reports we analyzed highlight two core reasons why investors got nervous despite that high revenue. You just mentioned the first one. The immediate focus on profitability.
Yeah, and the second, and this is maybe the more crucial point for anyone tracking supply chain risk, is this concern around customer concentration.
Explain that a bit more.
Well, when you sell these massive customized AI systems, those big contracts tend to be concentrated among just a handful of buyers. Think of the hyperscale cloud providers. So the market gets concerned that if too much of Broadcom's volume is going to just 2 or 3 buyers, those buyers have outsized leverage to negotiate prices down, which, further contributes to that lower margin profile.
This is the core lesson here and what you should really lock onto. Even when AI demand is clearly accelerating, the conversation immediately moves from how much are they selling to
how much profit are they keeping?
Right.
That distinction between top-line growth and bottom-line health is what drives volatility in the short-term trading view.
And that kind of news forces a rotation. So let's identify where that rotation is headed. First up, the segments that benefit from the sheer volume and infrastructure spending here.
We've grouped the winners into 3 key segments. Let's start with AI data center networking and connectivity.
The pipes, basically.
Exactly, the pipes.
Yeah.
If Broadcom is selling vast numbers of AI accelerators and related gear, you absolutely need the infrastructure to connect all those pieces. This is where demand for high-speed networking just explodes.
So we're talking about massive spending on switching technology, specialized interconnects, Ethernet upgrades, all the things you need to move these huge data sets between GPUs, accelerators, and storage units in real time.
That's it.
And the primary companies linked to this are, well, first, Broadcom itself, ticker AVGO, which is a powerhouse in networking ASICs.
Then there's Arista Networks, ANET, a leader in high-speed data center switching.
And we can't forget Cisco Systems, ticker CSCO, especially as they continue to deepen their enterprise AI infrastructure offerings. They all benefit from the need for these physical connections.
Right.
So if the data pipes and switches are winning, the next logical question is, who is actually building the raw components that fill those pipes?
And that takes us down the supply chain to the chip manufacturing and semi-equipment players.
Precisely. Increased AI chip volume, as forecast by Broadcom, translates directly and immediately into higher production needs at the factory level.
Which means more wafer starts at the most advanced processing nodes, the bleeding edge of semiconductor fabrication.
It also means increased requirements for specialized tools, complex process steps, and really intensive packaging solutions across that entire manufacturing supply chain.
Yeah, that whole ecosystem gets a lift. Key players benefiting here would include Taiwan Semiconductor, ticker TSM, the world's leading contract chip manufacturer.
And then you have Applied Materials, ticker AMAT, which supplies the critical equipment for processing those wafers.
And Lam Research, LRCX, which specializes in the etching and deposition tools needed for these complex processes. Their revenue is driven by, utilization and CapEx plans that stem from this massive volume demand.
Okay, so that brings us to our third category of beneficiaries, the platforms where all this capacity ultimately lives.
The cloud platforms monetizing more AI capacity.
Right. When the demand for AI infrastructure stays strong, it means these chips and networking solutions are being bought and deployed primarily by the massive cloud providers, the hyperscalers.
And these companies are perfectly positioned. As their capacity expands, they gain through increased AI service consumption.
So everything from selling time for complex training workloads to offering inference workloads, rolling out specialized co-pilots.
And enabling customers to use various AI application programming interfaces or APIs.
Yeah.
They own the real estate and they rent out the computing power. It's a great spot to be in.
The major cloud platforms that are the primary beneficiaries here are Microsoft, ticker MSFT, with its huge Azure expansion.
Amazon, AMZN,
Ugh.
through Amazon Web Services.
And Alphabet, GOOGL, via its Google Cloud Platform. They are really the ultimate customers funding this AVGO expansion.
That's it.
Now, let's pivot to the flip side. This is maybe the more complex part of this analysis. Broadcom's margin guidance created pressure points for certain segments. It signaled a rotation away from certain hardware-centric trades.
The first group we look at is what we're calling margin-sensitive AI hardware names. Broadcom's commentary on profitability has made traders immediately wary of specific sectors within AI hardware where competition is intense and the bill of materials, the BOM costs, are high.
Which could squeeze the gross margin.
Absolutely.
And this is where the conversation gets layered, because Broadcom, AVGO, itself is listed here, alongside Supermicro, SMCI, and Dell Technologies, DELL.
Right.
Now, hold on. We just listed Broadcom as a winner based on volume, but now it's facing pressure because of margin sensitivity. Isn't that a huge contradiction for a short-term trader?
It's not a contradiction, it's a bifurcation. It perfectly illustrates the short-term trading tension.
Okay, go on.
You buy Broadcom if you believe the volume story is what matters most. You sell or avoid it if you believe the profitability erosion outweighs that growth.
Got it. And for Supermicro and Dell?
For them, as key system integrators, the fear is that they have to buy expensive components like Broadcom's networking gear, but competition keeps them from immediately passing that cost through to the customer. That leads to margin compression.
That dynamic leads us directly into category 2. Server OEMs facing higher AI component costs.
This is a classic supply chain pinch. As we just noted, the demand for core networking and accelerator components is strong, which keeps their input costs elevated. The original equipment manufacturers, the OEMs,
The companies that assemble the final product.
yes, they often struggle to immediately pass these rising costs along to their own customers, especially in those highly competitive enterprise deals.
So the cost of the engine, the AI chips and networking gear keeps going up. But the car assembler, the OEM, can't raise the sticker price fast enough.
That's the perfect analogy. The enterprise customer always has options. This is why we see players like Hewlett Packard Enterprise, ticker HPE, under this kind of pressure. And again, Dell Technologies, DELL.
Dell is in both categories.
It is because they are caught right between expensive component sourcing on one side and competitive pricing pressure on the other.
Okay, finally, we have to look at the highly valued companies. The last category is high multiple AI semis vulnerable to profitability wobble.
This is a critical segment. These companies are trading at very high valuations based on projected future AI growth. If investors start to fear that profitability across the entire supply chain is under pressure, they tend to sell first and ask questions later.
Right. So when Broadcom says margins are lower because of product mix, the market immediately uses that as a proxy for the entire high-end supply chain.
That's where multiple compression comes from. It just means investors are no longer willing to pay as high a price-to-earnings ratio for the stock. If the key component maker, Broadcom, sees margin pressure, investors fear it's contagious.
Even for players like NVIDIA, which is currently enjoying near monopoly pricing on its core GPUs.
Even for them, the risk immediately justifies some profit-taking and a lowering of valuation multiples across the board.
So the high multiple semi-names specifically mentioned as vulnerable here are NVIDIA, ticker NVDA, and ARM Holdings, ARM.
Correct. Their growth expectations are baked in,
Yeah.
but their valuations are sensitive to any sign of system-wide profitability erosion, even if the demand for their own product remains stellar.
What this entire sequence of events underscores is that sophisticated tension at the heart of the current AI economy. Yes, capacity expansion is undeniable, demand metrics are strong.
But the market's focus has evolved. It's beyond mere capacity now. It's about sustainable profitability. How does that growth translate into a healthy, consistent bottom line for every single player in the supply chain?
That's the takeaway you should focus on, the difference between revenue growth and margin capture. That distinction is where the short-term market action is focused right now, and that's the signal you take away from this Broadcom forecast.
Before we go, we must provide a disclaimer. This information is for educational and informational purposes only. This is not financial advice or a recommendation to buy or sell any security. Any views expressed are purely the opinion of the author.